Hello, everyone. I'm Tammy Castrini from Insurance Advisors Direct, and I have Bill Tarrant here, one of our agent partners today. And we are going to be talking about HSAs and IRAs and everything we can do to assist our clients. So, Bill, I will go ahead and let you share the screen. And just so everybody knows, we will let Bill do his presentation, and then at the end, we'll have a live question answer session. You will raise your hand, and then I will unmute you, and you'll be able to talk with Bill and get your questions answered.
Well, thank you very much. We should have brought everybody into our earlier conversation. Today is a dynamic time for us as insurance agents. I can't tell you how many. Remember when internet came on and everybody's buying their insurance on internet? Now everybody really wants that personal interaction. So a little bit about our business. So we started out in the insurance world, but then I morphed over quickly also into taxes. So I kind of came from government accounting and had an IRS agent that retired that worked in the office. He was looking for somebody with to work through tax season with him. And we started doing that, but we started seeing more and more businesses come in. And he would call me over for insurance advice, and then I would bring him in as we're advising somebody who wanted to put a group plan in on deductibility. We found out that, man, these two businesses meld so much together. I've really become their insurance, financial, business setup tax advisor. So we've now made a whole division. We formed Apex at the start of 2024. I have some wonderful partners. One runs our commercial insurance division. One backs him up, runs the individual P&C division, as well as both of them morphing over into Medicare and AEP and the under 65, the ACA. So they've never been involved with taxes. So all of a sudden, I laugh when Julie, my partner, who I'm sure is not listening, but her husband Larry is, when Julie's talking, and I hear her talking to a client off in the distance, and she's like, "Well, she said there is some deduction you could take from that, and HSAs are a beautiful thing because it lowers your is going to lower your overall taxable income. Wow, you really should make an appointment with one of our guys just to talk about that." So we've melded into so much so that when Tammy asked us to do this, I'm like, you know what, just give me 15 minutes. Just, I don't want to go over half an hour. I don't want to waste anybody's time, but this is a really easy process when we're talking about this. This has more to do with our ACA, our U65, but I bet you every agent on there is probably a good chance that they're a 1099 agent or they've got some 1099 business. So really they're a business person too. So there's some other things that they should understand. But when we talk about the Maggie, there is no number on your 1040 on an 1120S for an S corporation or a 1065 for a partnership return. There's no number that you can go to and find your Maggie. You work with these people for marketplace. You're like, hey, what's your modified adjusted gross income? I don't know. Where is that at? What number is that? Number 11? No, that's your AGI. Well, really, Maggie is defined as it's your adjusted gross income, but for marketplace purposes, it's going to be a little bit different. We're going to look at that in a second. But Maggie can be used for a few different things. It can be used to decide whether you're available to give into Roth contributions. So the things that get added back in is you're going to take a deduction if you pay back some of your student loans. So if you're doing that, that comes above the line. They add up all your income and they're just getting ready to come down to your adjusted gross income. They're like, well, wait a minute, you get a deduction for this. You paid back some of that. So let's lower your taxable income. That's good. You might have some tax exempt interest that comes from like bonds that you might have invested in, tax free bonds, some of those shelters that we have out there. If you have some untaxed housing income, maybe your clergy, military, or some foreign income, there's some different rules that it may have came in where it's not taxable as a U.S. citizen, which on untaxed foreign income, that's kind of rare. And then part of your Social Security, I'm not going to go through that calculation, but if there's somebody that's on Social Security, they can take it early if they're disabled and they haven't qualified for Medicare yet. They got about 2 years after they qualify, or if they take it at 62. and which is another thing they come to their insurance and their accountants for. Man, should I jump onto Social Security early? Well, there's reasons for it. There's also reasons you shouldn't, but those all get added back in. So on a standard person just collecting Social Security, for example, it can be as low as 50% of your Social Security being taxable. So if it's just you, you're single, and you're getting $24,000 a year in Social Security, 50% of it would be taxable, which is $12,000. But the standard deduction is 15,000. So following the standard deduction, it's not taxable. These people aren't even filing taxes, so they don't even know what their adjusted gross income is. I've had people early on that were put into the marketplace and they were told, oh, no, you don't have to claim that other half of Social Security income. Let's just claim your wife's salary and the 50% that you're being taxed on, which shows on the tax return. Nope. That modified adjusted gross income, we have to take that full 24,000 that they were paid. When we talk about just the ACA, this is the best one, and I shouldn't have cut them out, but I did. I think it's healthinsurance.org. I should refine that slide and put it back up there so we have their logo on there too, because I did steal this from them. But this is probably the best one that I've seen when we're looking at this. If you look at line 11 on there, on the 1040, that adjusted gross income, add in everything from that Social Security that wasn't taxable, bring in that tax exempt interest. There's two lines on there. One shows interest and one that shows how much is taxed. So anything that wasn't shown in the tax was that tax exempt, bring it back in. And then again, that foreign income. If we do that, that's that modified adjusted gross income. Now, this becomes really important when we start looking at things like an HSA. These are deductions that aren't added back in. So this is what I need to add back in if I'm looking at my Maggie. Sorry, I'm recrossing my legs, folks. I'm at the local Starbucks doing this, so my German Shepherd didn't drive you guys crazy with the mailman. Uh, but when we're looking after this, these are things that we can do, a client can do that can reduce their taxable income. Why is that important for us? Well, when we're looking at marketplace, I can lower your taxable income, get you a better subsidy, and with an HSA, I'm not even losing the money. In 2026, as we start to look, a single person can contribute legally $4,400, and a family is going up to 8,750. If we're 55 and older, you can contribute a $1,000 catch up. Now, before the latest tax changes, which has become a new hotbed topic for a lot of insurance agents and tax advisors, and how we can help people. Before this, if you were filing married, filing jointly, you could only use one of the 1,000 catch ups. But there's been some changes in the last couple of years with the one beautiful bill where they've been trying to push this, that after 26, if both husband and wife are over 55, you can contribute up to 10,600 into into your HSA, and that money comes out pre-tax. And if you went and did an HSA and you didn't have it taken out of your paycheck, it's okay. You can do that. There's a spot on your tax return where you put in that I contributed to an HSA, and you get that weight above the line, above your adjusted gross income. Actually, after adjusted gross income, before we get to taxable income, we get that weight of lowering that income so that we're going to save taxes on that money, and then we're going to report to that. Well, why is it such a great thing? There's a ton I could do with that. Maybe I only pulled a 3,000 deductible plan. Why in the heck would I put in 10,600 if I'm only pulling 1,600 is the new number, so 3,200 on a married couple, I think. So if that's my max deductible, might only have 0% coinsurance after that, or 100% coinsurance. I don't have anything maybe except for prescriptions. Well, what can I use that HSA for? There's actually a publication from the IRS, and I wasn't going to put it all on here, but as many of us know, anybody got dental work being done? That's a great place to save. If I'm getting ready as a senior and maybe I want braces, corrective, anything else, there's no insurance that's going to pay for that for me. It's going to be considered cosmetic unless one of a few things are going on. Maybe I've got to have implants done, or a lot of our insurances don't want to do that. We actually can be putting money into an HSA and it can carry year after year. Remember, we don't lose that. We can do optical, we can do LASIK surgery, we can do some over counter stuff, first aid kits, not for business uses, not for your office. You can't buy toothbrush and toothpaste, even though it's great for your dental. You can't buy floss unless there's certain toothpaste that your dentist tells you that you have to have, or your doctor, because you might have some gingivitis or some other issues that's going on. Then it does become an item that you can use with that. The other thing that we can put into that I wanted to kind of highlight and talk about was HSA is my by far my favorite. I can do a whole nother. I have actually asked Tammy to throw it up to the higher ups on ID. I want to come and I want to do some 10-10 meetings on some more of these items and really delve in. I want 10 minutes, no more than 10 slides, and we're going to cover each of these topics a little bit more in depth. But even you, as like an agent, if you're a 1099, I can go out and start a solo 401k. And if I do that, and I'm looking at these solo 401ks, if I'm with my employer and I max out my 401k contribution, those are all before my taxable income in that adjusted gross income range above the line. I'm lowering the amount that I'm reporting to the marketplace, and my subsidy can be higher for money that I pay to myself. I put in my own HSA, I put in my own IRA under certain circumstances, I put them in my own 401k. There's a whole nother avenue that I would do in those 1010s where we would talk about self-directing. Tax advice is the number one thing that I do. I'm the partner that really runs. I delve a little bit into Medicare still. My wife has graciously taken over most of my Medicare book, adding, five, six, 700 to her couple hundred, and she's there. All the other agents are handling it, but we're still coming in for this advising because we're ending the tax year. This is primarily what I do, and you could have an IRA where you self-direct. You could be invested in a whole number of things, and you're contributing that $7,000, $8,000 a year, depending on where you're at, up to 8,500 now with catch up, and you're lowering your taxable income. I wanted to give a couple examples because I want to get through this, and we're going to be approaching that 15 minutes here pretty quickly because I tend to talk a lot. But if I look at a couple, a him and a her, married filing jointly, they're both 45 years old and they're living here in lovely Houghton Lake, where I'm broadcasting from live with ID. If they're in this area, and let's say that a combined income of 65,000 annually, this little slide here I pulled right from. I use Health Sherpa when we're doing our ACA or our Medicare. I love their platform. Little shout out for them. I make no money from them, but I throw out this right here. So a monthly premium for two 45-year-olds, male, female, 48629, with 65,000 annual income is 1,045. Now there you can see where their subsidies coming in. That plan should have been about 1,900. That's not getting them that bad of a deductible, 1,400 per person. So not quite an HSA compliant plan yet. We're going to change that with some of the stuff from the One Beautiful Bill, but they're getting a decent deductible. But that max out of pocket exposure is 18,000, and it's a PPO. So we've got a little bit broader network. A lot of those doctors like that. But if I take that same group, same sweet boy, same sweet girl, old girl, or whatever the heck that song was, and I'm going to reduce their income by the amount that these 45-year-olds, that 80, that 8,000 and some, that 8,500 that they could put into the HSA. If I did that, would I take them down to like 52,750, something like that? Their monthly premium for an HSA compliant plan just dropped down to $223 a month. Now, if you remember, over here, they're making 65,000. They're going to spend 1,045 a month, so at least at 12,000, and their deductibles are another 2,900. So we're at like 15,000 between the two of those that they're putting out if they both need care. Over here, a little better than 2,400. They put into premium for an entire year. Now they put 8,500 away pre-tax, 65,000. They were in a 12% bracket, by the way. So by putting that 8,500 into their HSA pre-tax, they only saved 12% in 8,500. So they saved $800, $900. I'm not even going to claim that benefit right now in my number calculations, but they paid a little over 2,400, and the 8,500 they put away pre-tax, they spent to get them both coverage. This plan has 100% co-insurance. After you hit, look at it, after you hit your $8,500 deductible, your max out of pocket was 8,500 per person. So as we start to look at it, yes, could they both have it? Could they both have that massive sickness? It's pretty rare. But at that point, we took what they were spending 15, 17,000 for over here, and we moved them over to a different style plan where they were allowed to premium. Never mind, they bought it, paid $223 a month, had prescriptions, got to see their doctor a few times, and they didn't even get sick. They didn't use it. They just put $8,500 into an HSA, which they were allowed to do. There's several investment vehicles, health equity, which comes with Priority Health and Blue Cross. You can get that signed up for your HSA as well as your local banks. But health equity even has an investment side. If you got over a couple grand in there, move the rest of it over there. You can be investing in Vanguard funds, making 5, 6% off your money, and it stays tax free until you take it out. Now, if you take it out after 65, then it's treated as an IRA, and you can take it out for non-medical. But if it's before 65, yep, you gotta take it out for medical only. But you can pay some Medicare premiums or some insurance premiums as long as it's not marketplace and some other rules. You guys, any businesses that you're talking to, they're still shopping for insurance through you. There's some other reasons for this, and I wanted to highlight there's some big changes out there. My adjusted gross income being in business comes from my business income. So when I start talking to these businesses and they're like, why is my premium so much? Well, you capitalizing on all your business expenses to lower that business income. That comes over from Schedule 1 into 1040. It's calculated in your adjusted gross income. They're like, what do you mean? And I'm like, well, you need to minimize your business income by maximizing all your expenses. And this one beautiful bill has a lot of changes. We're spending a ton of work with people. But one of the biggest ones I pointed out is line 2 there, 100% bonus depreciation. If you're buying a vehicle and it's truly for the business, 100%, there's insurance rules versus taxable reasons. It can be a business expense as long as no more than 40% of it is used for personal. Insuring it normally needs to be less than 10% as a commercial auto. But when you're looking at this, if you buy that car, I don't care if you took a loan out or not, as long as you put it into service before December 31st, they just passed 100% bonus depreciation that started in 2025. If you bought a 20 and it has to be over 6,000 pounds, a lot of my contractors were talking about this, a Ford F-150. My partner's loving that I use that. I would never claim to use an F-150 for anything other than a doorstop. But if you buy the F-150 and you get anything bigger than a crew cab, the weight is over 6,000 pounds sitting on the curb. They're at about 5,600. You add anything to that, and you've crested that additional 400 pounds. You get a 100% bonus depreciation as if you had it in service for the whole year. There's a qualified business income deduction. It's going up to 22%. Right now, it's at 20%. Take less in your wages that you take from your business, take more in your profit from that, and that's affected by the QBI deduction. That's taken right off your income. There's several things that we can do as employers, contributing to our employees and our own HSAs, whether we do it as a self-employed, back on our own personal, or as we do it as a business expense for our businesses. I can self-rent my property to myself. There's a couple different ways we can do this. One of them is the Augusta rule. You can rent from your home, from yourself, your home for true business purposes at the going rate for up to 14 days a year. Take the deduction as a business, and you don't have to use it as income on your personal return like a Schedule E where you're renting out to people. And then phantom income is huge. It doesn't cost me 70 cents to drive my vehicle. I drive a Tahoe. I get 23 miles to the gallon. I just spent 270 on gas here in Michigan. With my discounts, I was actually down at 250. So I'm spending 12 cents a gallon. I ate my oil change, my tires, my wear and tear. If I all calculate it out, I'm still over under 70 cents. But the federal government says I get 70 cents a true business mile. If I have a home office insurance agent, if you make it your true home office, your principal place of business, where you are doing all of your administrative work, there's 3 IRS cases out there that have ruled that that is a home office, it's your principal place of business, and you can take any mileage from there. A lot of us are guilty at times. I think of deducting mileage leaving our home to an office or to an appointment. You didn't leave an office, you didn't leave a principal place of business. So some of those aren't necessarily deductible. We need to be careful with that. And we need to establish some of those things. So when we start looking at this, it's the value of this advice that you're giving them. It's the value of these deductions, what they get for you in the end. It's not that 8,500 going into the HSA. I realize it's a large amount. It's 8,500 that was less taxable to the government. I still have it saved up for those expenses I'm going to need in the future. It's the value that I get from it that by far is the biggest issue here. So a little short disclaimer. Again, I made no money off of anybody's product that I mentioned inside of this. I teach for the American Heart Association at times too, so and some other medical groups. So we have to have some of these big disclaimers. But this is not a attempt to establish a relationship between us. Okay, so I'm not going under a client practitioner relationship. You need to get with an enrolled preparer, some licensed tax professional, to make any of your own decisions on this going forward. But if we can be of any help to you, we've got 3 offices. We serve all of Michigan. We're in quite a few other states right now, but we have offices in Gladwin, Baldwin, Houghton Lake, and coming soon, kind of a mini tax office over there on Beaver Island. If you guys are looking for a good place to eat, there aren't any on Sundays because we're all closed, but we can point you in the right direction. But I even included my business cell phone on there. Shoot me a text. If you want to talk about something, I hate when agents won't help other agents. I don't want to reinvent the wheel. I sold a lot of the things I just told you from a great guy named Mark Kohler. He does presentations through Main Street Media or Main Street Business. They've got the self-directed IRAs. A lot of their advice that I talked about with some of those business things for you are things that I've learned from them and now have given to my clients. I've done some of their programs, so feel free to do some investigation. But if you want some help, reach out. I'd love to answer some questions and see if we can be any help to you. I think I kept it under close. Maybe that was close to 15 minutes.
You
Oh
did
no,
great.
23 minutes. That wasn't too bad.
It is a lot of information. You did great. Thank you
All
again
right.
for the
What do we got for
presentation.
questions?
All right, so I'm going to start with some Q&As first, and I'll move over to the raised hand.
Yeah.
So if you have questions, go ahead and raise your hand and we'll get to you. But the first question was, can you explain family versus single contributions? Is it based on health plan
Yeah.
or how you set it up at the financial institution?
So it's not where you set it up. If we're talking HSAs, single versus family, it's the health plan, who we're insuring. Do we have, and it's not even just family, it's husband and wife even. If there's 2 people, it's a family if it's you and a child that you're insuring. So if we're doing that, then we're afforded that family level deduction, that 8,500 with catch up, everything else we can go up to that 10,600. So it's really based off who it's insured. There's some questions when we're looking at the deduction on the tax return. Was this deduction, if there's a W on your W-2, did it come from the employer, his or her employer, husband, spouse, employer, where it came from? But when we get down into the minutia of you going to your local bank and cutting that check, who contributed it? Who's the social security number on that? Is it husband or wife? One of my agents just brought up a case where he and she both worked for entities. She's recently retired, but she still has an HSA. He is working still and has an HSA. Now she's moved over to his insurance, So we started talking about there's some catch up there that they didn't do during paycheck. Where's that? Who writes that check? They also have a business. She's being paid by the business. So we really started bouncing those things around. And he's one of my accountants. But as his accountant, as his business advisor, we really started delving into that. This is why I threw that disclaimer on there. You need to go see somebody because the health plan was under him. It's a business could give to an employee. So she's on payroll through the business. She could take some money there and the business could take an HSA deduction, but she doesn't have an insurance plan anymore. She's over on his. So realistically, it carried more weight bringing it in as a personal check they wrote, deposited into an HSA, same weight on their taxes. There's just a little legality in there, but not to confuse it. A family is a family. It's dictated on who's insured, how many people are insured.
Okay. So that shows it's really important as agents when we get these questions or, HSAs are popular now. They're getting more popular
Oh
by the
yeah.
minute. Definitely they're looking at that with any health insurance reform. So it's really, really important that they do have the client talk to their tax professional, make sure they're doing it the right way.
And we didn't delve into that, Tammy, just to stick on that point. I didn't delve into it too much. And I just kind of floated over it in one of my presentations on the One Big Beautiful Bill. But there's some changes on the healthcare plans that they're going through right now on any of the catastrophics qualifying for, if I understand it right, for HSA
Hmm.
classification. Before, with Obamacare coming out, there was rules. You've got to have your skin in the game before the plan can start to pay, and there were several things that made an HSA, but they're really loosening that up. So at that point, we as the advisors, insurance advisors direct, we as the insurance
Hmm.
advisors and we as tax advisors become so important in understanding how we can benefit the client. If you don't have a tax person, grab one of my guys or ladies. They'd love to work with you. Self referrals, direct. We refer stuff back and forth. We rarely charge for stuff like that, just to establish those relationships. Get somebody in your back pocket that you can refer them to get these questions answered.
Absolutely. That's wonderful. And it's also a great way to do, to partner with somebody locally and do
Oh yeah,
presentations because, as agents, we're just learning how all this works. And so imagine how the consumer feels. So, it's a great way to do some grassroots marketing and relationship building as well. So, this will be a great time as we roll into 2026 and wonder, what are we going to do now? So,
yeah.
and I think you've probably touched on most of this, but just to reiterate, if a husband and wife each have an HSA and they're both over 55, can they each contribute the catch up, which in your presentation you did say they can now
Yep,
for
and even
2026,
now,
right?
and that threw in another conundrum to, well, it wasn't a conundrum, it was another bonus. If they were married filing jointly and they were both, I should have addressed that, and they were both on the same insurance plan with one HSA, then they could only do the one catch up was the way that some of the legal experts were understanding it. I can't find any case law where the IRS really had a judge rule on this, so I never really pushed the issue. But if they both had separate and they were both putting into it, they both could put catch up before this. Now it's with the changes that are going, it's definitive. If you are both on the same plan, both putting the same HSA, both over, now we can do those catch ups inside those ones. So yeah, absolutely. To answer that one, yes, they both can make that catch up.
Fantastic. Thanks again. Okay, so we are going to move over to our raised hands. And the first one we have is Peter. And Peter, hang on just a moment, and I will allow you to answer or ask your question. Okay, you should be ready to go. You may need to unmute yourself, though.
There he goes.
Got it. Okay. A lot of great material here, and I'm not sure I'm going to even ask this question appropriately, Bill. But thanks for speaking to us today. Got a couple realtors. This will be come 26 will be a first full year of them being realtors and 1099.
Okay. Yeah.
And I'm trying to work with them on their insurance, and then they're getting some subsidy, but then their concern was, well, we have no idea where the revenue is going to be, and we could exceed that, and maybe this is more of a Medicare question, but the HSAs sound great, and that could be a little bit of a lifesaver for them. But if they exceed, the 80, what it looks like an $80,000 threshold for subsidy stuff, they're looking at, I don't know, paybacks. I don't even know or taxes there.
Right.
And that's not a bad thing, right? Because they're making more money.
Well, it's not, but it's also you have a CPA or tax advisor close to your office, Peter.
Sure.
So develop a networking opportunity here. I can't tell you how great this is. So what I do with realtors is I explain to them that your broker that you work under can only pay a licensed realtor. It can't pay a business. Brokers can be businesses, but real estate agents, there's some legality on their guys there. But the IRS, there's enough case law out there that there's nothing stopping them from forming an LLC and becoming a business. So when they become a different entity business, there's some liability reasons that we like that. But better than that, they're going to get rid of some self-employment taxes that way. Your tax person you're going to work with is going to help them through that. We can also control their income. So we put them on payroll for a reason. So we think this is what you're listing. This is where your sales. I meet with my realtors every quarter, and every quarter it's like you just bring me your sheet. Just bring me your sheet on what comp you've paid. It's almost like reconciling a bank account. What have you been paid on, and what have you got hanging out there that you've got listings on? Now,
Oh,
you could become a seller's agent and you could take them to see somebody else's listing, and that's going to happen. But what do you have out there? I got pop ups. Sorry, guys. If you guys saw, or I think I stopped sharing my screen so you didn't see my pop ups. I got customers wanting to meet. So when we do this, it gives us the opportunity to share that. Now, you as the insurance agent, it's going to put a little bit more work on you, but the onus is still on the customer. It's their responsibility. Every one of our marketplace knows you're in business. Your income ebbs and flows. You don't make $18 an hour at 40 hours a week, 2,080 hours, and I can put that into the calculation. You're now going to ebb and flow. So you're responsible to get a hold of me every quarter, because when we reconcile this on your tax return, if your income went up or down, you're not getting hit for the entire year. You're getting hit in a more quarterly basis because you had income that went up, and you're not seen as bad fines. Some people that were lower in income were not being made to pay back those fines. Unfortunately, that got changed with the one beautiful bill. I understand. I haven't explored too deeply into that, but they're gonna get all their money that they got back in too much subsidy. To answer that question, it's going to make it easier for them to keep control over that. Base it off what you think you've got for last year, and then let's raise it as soon as we need to because you're making more income, or lower it because you're not making as much income. I would never encourage them as your tax advisor to lower it.
hmm.
Listen, you're making less money. I understand, but you're also making your bills every month. Give yourself a little bit of a break. If you don't get enough premium tax credit, they're going to give it to you on your tax return. But also get with that tax accountant to make sure that they're running everything under a business, taking those QBI deductions, maximizing on a plethora of business things that are out there.
Good. Thank you.
You're welcome.
Yes, thank you. Great answer. I don't see any other questions, so I'm gonna allow people another couple of a minute or so to
Probably
do
because they
so.
fell asleep. They're like, this guy must be a preacher, man. He gets up on a soapbox and he doesn't shut up.
That's funny. Um, we know that's not true. Anyhow, so as we're looking at the end of OEP, we've got, 10 days left, and
Oh,
then we've got the
oh
extended
yeah.
OEP. Some people have already gone into plans and they may not understand, that all bronze plans and catastrophic now are HSA eligible. They
Mhm.
hadn't really thought about this to talk to their clients, but now is the time. They're allowed to
Yeah.
change them until the 15th or even until January 15th for a February 1 change. So would you encourage people to really
Oh,
take another look at
definitely.
this?
And I'll actually talk about a personal. I had a business partner in the past who actually threw this into my radar. we insured each other as the owners in an HSA plan, and I really liked them. For groups that we put group insurance in, I would rather do it as an HRA, where I buy them a high deductible plan as the employer. If they don't use it, I don't have to pay anything in the HRA, or I could give them an HSA, but I'm out that money either way. But there's some benefits both ways, and we saw some savings. But he talked about a medication that he was on at one point, and there was a discount to the manufacturer, but the insurance still would credit it. So my wife, one of our agents, has been diagnosed with both rheumatoid and psoriatic arthritis, and so she has now been moved up to some higher drugs, and some of these drugs are like $5,000 a month. Well, we're on an HSA, and I'm on a 5,000, actually a 4,000, 8,000 with a max out of pocket of 612. So in the first month, she met her deductible. In the second month, she met my deductible for me. So by February, I had met all of it. Now there's 100% co-insurance after that. So I've got no cost except for bariatric infertility treatment, which I'm not having, prescriptions, and durable medical goods. So wow, that was a really good thing. By month three, she met her max out of pocket. She pays for nothing at this point. Now I've just got a little bit of exposure of meeting those things, 50% durable medical goods, my prescriptions at set copays until I meet mine, which I never will. I've got a few scripts every month, but you've got a client out there that probably meets this guy somehow. And if they start talking about their medications, because you're checking plans and you're checking specialists to make sure they're in network, if they throw this down your on your radar, just hey, I don't want to go into too much of your medical, but if you're on some pretty high plans and you're telling me that you don't need to worry about your insurance covering that because the manufacturer is, an HSA might be the right case for you. Here's why. And for us, it's worked out very well. So it's not too late to work with your clients. It is not too late. You've got 5 clients on your mind right now since we've been talking about this that you can go back and hit, and you're going to become such a trusted advisor for them. They're going to trust you for everything else, and you're going to refer them over to some guy that does home and auto or lady, and that home and lady is going to give you some referrals back on the other side, and where we can all stop reinventing the wheel and take care of each other.
Oh, that's fantastic. And then they can also contribute through the year to the HSA as well, right? So if they get
Absolutely.
to the end of next year, it's
Mhm.
not, that's something that they can do, or the IRAs potentially.
Yep. And if
So,
you're doing certain things and you have that preparer, your accountant, your CPA, your enrolled agent, like mine says, I'm an enrolled agent. 3 people, by the way, represent you before the IRS: a tax attorney, a CPA, or a licensed enrolled agent. We all have to take all these tests and all this weird stuff. But anyway, I want you to really get into one of those avenues because they're going to be a little bit more exploring these things on most of these cases. But if I need to up my contributions to save myself on adjusted gross income for any of my, even me as a business person, I have until the tax deadline of filing to make last year's HSA contributions. I have until those tax deadlines to make last year's IRA contributions. As a business, if I file an extension until September 15th for a partnership or an S corporation, I have until September 15th to make the contributions for last year. So if I'm the only person that's on that and it's a SEPR, or if it's another solo 401k, and okay, I need another $9,000 in deduction to lower my adjusted gross income, they have an extended amount of time. Is it helping this year on this health plan? No, but you're giving them something to take to their tax preparer to kind of kick them. You just helped them out with another problem. And now we have a set plan going forward. They can contribute all year and save themselves.
that's fantastic. All right. Any other questions? I know it's a lot to process, so we will be
Yeah,
doing we will be doing more in the future. The 1010 you talked about, and
I
probably
hope
some
so.
more like
Yeah,
this.
I'll be
And we
more than
also
happy.
have another webinar today at 1 o'clock,
Mhm.
and you are all welcome to join that again if you think of some questions that you didn't, or reach out to me and I can get you in contact with Bill if you think of questions afterwards. But thank you again, Bill, and everyone for your time. I know this is a very busy time of year for everybody, so we definitely appreciate
It's
you
almost
keeping it.
over with, kids. It's almost over with.
That's right. We're in the final countdown for AEP. So, chins up. We're all here to help you, and we look forward to talking with you soon.
Have a great day. Thank you.
Thanks, everybody. Take care.